Time.
You're live.
We are live, okay. And Jamie, did you want to say a few words first?
Nothing for me, just jump right into the agenda with Gail, Madam Chair. Thank you.
Okay, so we're going to start with Gail Newman. She's Vice President of Risk Management, Bright Horizons, and she's a captive owner.
I am. Thank you and good afternoon, everyone. It's nice to be here. I really appreciate the opportunity to come and speak with you all. As mentioned, my name is Gail Newman. I'm the Global Vice President of Bright Horizons Family Solutions. Long tenured company. We're our fourth decade in business, not only focused on early childhood education, aka what I call daycare, but also backup care services, which I'll delve into in a little bit, and why having a captive domicile here is so critically important, especially now more than ever. But also we offer a whole host of additional services in the elder care space, along with educational services, not only here in the US, but we have a broader footprint in the UK, the Netherlands, India, Australia, and partnering with various European countries with some of our service lines. We've been domiciled here with our captive. We're in our 7th year. The irony of that is very happy that we're domiciled here, yet this is the one state where we do not do business. Right? So I also want to add that I am just finishing out my 2nd year serving on the Vermont Captive Insurance Association's Board of Directors. So a lot of great work, a lot of changes going on given the evolution and the expansive growth with the captive industry. So we domiciled here in Vermont, just as I was beginning my role with Bright Horizons coming up on 7 years ago. When you work as intimately as we do in the early childhood education space, there is a very large need for liability coverages, particularly in the sexual abuse and molestation space. It's not a great topic that doesn't necessarily roll off the tongue, but it's something that's very necessary, not only to operate, we cannot operate without it, not only here domestically where our captive is today, for the domestic part of our business, but also international. We're seeing growing pressures on that liability coverage more broadly across the globe. And we also have a very large network of what we call client-based care that demands contractually that we maintain really significant levels of insurance coverage. What does that mean? Client-based care is a great employee attraction and retention strategy for many, many clients. We have thousands of clients ranging from Apple to Universal Studios to healthcare companies, you name it. We have them in our book of business. And when you become employed with these companies, you're offered your regular host of benefits, whether they be your health, your vision, your dental, your 401k opportunities. But then they also open up the suite of Bright Horizons offerings that say, if you are an employee of XYZ company, you are afforded a 50% subsidy on your childcare because these companies employ and maintain a take care center on their location, or they offer them a host of backup care services, and the list goes on and on. So it's proven to be a very good service and product line for our business, but it's also a great retention strategy and improvement strategy for many businesses out there. But it also comes with cost implications on the insurance side. So it's one of the great success stories, and in many circumstances, a competitive advantage for our business because we can offer, because of where we are, having this domicile in the state of Vermont, we're able to give those coverages to our clients. So fast forward to where we are today. This couldn't be a more perfect time for me to be sitting in front of you. We are literally in the process of changing our business plan for our captive. And a few reasons for that, which I'll walk through why, again, this is a very critical partnership with the various business partners we work here with the state of Vermont. The pandemic, like it did for so many businesses, really impacted our business, albeit negatively, in that when the world shut down, we furloughed about 80% of our business. And that meant the childcare providers that we struggled to attract and maintain 4+ years ago were now gone. and had to go find other jobs. And when we started to open our business back up, when the world started to somewhat normalize again, they didn't come back. These caregivers didn't come back, and their feedback was, I can go work elsewhere, namely a Starbucks, a Whole Foods, and make more money, arguably get a better benefits package, and not have the stress of watching children. And that really has always been a challenge for the business, but it was a pause for us to say, we have to start being the leader in the industry and paying these people more. And with that comes kind of the checks and balances of, if we start paying our teachers more, where do other things need to give? And that has primarily been a big focus on our overhead functions as a business. Insurance is a big spend. And we started to think more strategically about how can we leverage our captive, not only with the general liability that we have in it today, but also how we put more expensive lines of coverage. I'm sure you're all impacted, either your auto liability premiums you see personally going up, your healthcare benefits are going up, and the list goes on. Your cyber coverages of the business, everybody is having breaches. It's just becoming norm. And with that being said, we are literally just throwing premium away and not getting anything for it. So we're looking at changing our business model to start to envelop those coverages also in our captive, so we can start using our money more strategically, invest it more wisely in our captive, so we can continue to be the leader in paying our care providers more money. So the second piece of why this captive is very critical is that the pandemic also was a big push in the shift of our business model, where we've seen significant changes in the typical 5-day-a-week. You bring your child and drop them off 9 to 5 at a brick and mortar daycare location. Many people, including myself, are not going back to the office 5 days a week anymore. So the need for that brick and mortar location has definitely changed. But we also have a very large service line called backup care, whether it be for a child, whether it be for an aging parent who needs some support. That part of our business has exploded. And much in the way that we are challenged with the retention, the attraction and retention of talent, we can't possibly outfit backup care in all the different corners of the world, where we're not central in a city. A lot of our childcare centers are in cities. Now that people are out in the spokes of the more suburbia of where they live, we have to leverage what we call a third-party provider, more a mom and pop type of a location or a smaller scale business, to be able to provide for our backup care. And essentially what backup care means is somebody's going into your home or at a location where you may be working remotely to provide care for your child. So that's become a significant part of our business. And if you think a brick and mortar location is uninsurable, sending someone into somebody's home when you're not in a ratio and you're not monitored by a state licensing body, the insurers really look at that and go, yeah, not doing it. So we have third-party providers who are becoming increasingly more challenged. The trickle-down effect of the traditional insurance carrier, traditional risk models is starting to impact our third parties. And they're coming to us and saying, Bright Horizons, what are you doing? Can you help us? So fast forward to the second piece of why this captive is so critical. We are also creating a new model, a new cell for our franchise system. We are a franchisor for a very significant franchise business, and we are in the process of changing their entire insurance model to put them in the captive to be able to provide the general liability and also that sexual abuse and molestation, so they can continue to provide us with the best caregivers for our backup care business, but also honor their contracts with their clients. So as we move forward and we're looking at evolving not only the business, that's really critical, and the liability, we're also looking at different lines of coverage because it's just not feasible anymore. Companies are very much running on a strat budget, ours being one of them, and we are doing well profit-wise, but we're also looking at how do we continue to be able to pay our care providers and look at ways to do that, and captive has been one of those ways. The last thing I would add too, I think, of why it's really critical and why Vermont. Now, we don't do business here, but why Vermont? And if you'd asked me that question a few years ago, I would have said, no, logistically, it's close. We're in Massachusetts, we're just outside of Boston, a Boston-based, globally headquartered business. But I think with the pandemic, that really shifted my thoughts, and that while it's great to come up and liaise with the many business partners that I have physically in the state, it's not that I'm not getting an absolute benefit throughout the pandemic with just a Zoom or a phone call away. So I think, for somebody who may be in Texas or Seattle, Washington, thinking why Vermont, I don't want that ever to be construed as a benefit. And I think by way of being on the board, we're able to help broaden and communicate that message. But the last thing I would add is that, with overhead functions and budgets being very tried right now in our business, my internal team is incredibly small. And when you're managing a global footprint with the various intricacies and different laws and regulations and litigation matters, whatever it may be, I look to a lot of the business partners here that I have that support my captive, whether it be Sandy and her team, whether it be my actuaries, my auditors, my captive management company. They're an extension of my team. And they're literally a phone call away. There's never been a time that I haven't picked up the phone and said, hey, we're having some challenges with our franchisee system. Can you help? Yes, absolutely. We have an expert in our office right here on Church Street. We'll get that person on the phone with you. They have 3 other clients who are in a similar situation. We're going to be able to stand up a self-captive for you within 60 days. So I think that quick response is something I just wanted to add to. I've worked with some competitors in our industry who have called us in the last year and said, hey, we're really challenged. What are you doing? What are you doing for insurance? And we said, well, we're a publicly traded company. Just go take a look at our 10K and you'll see that it's disclosed that we do have a captive. What's that? And, why should I do it in Vermont? And he said, because you're not going to get access to the best education and the roster of expertise that, in my mind, you can't get anywhere else. And I think even just as we expand and look to strategically position our captive to be prepared for when the other shoe drops on the liability coverages in our global locations, we're not there yet, but we see it coming. We're starting to see changes in the footprint of the coverages where we do business today, is that we're starting to line up our captives so we can do a quick pivot when we need to start enveloping our international operations in our captive. So I think I've hit all the key points that I wanted to hit, but I definitely want to know if you have questions as well. I'm happy to answer any of them.
Okay, any questions? I'm gonna kind of move this along because you've got a long list of people, yeah. So thank you.
May I have just one question? And that is, you're doing great business in Vermont. We welcome you and love to have you here. Why don't you do any business in Vermont?
So to quickly answer that question, I've had some conversations with Joan Goldstein. She reached out within probably the last year and said, how do we, and really not from the angle of the insurance side of things, but more so from how do we make this work here? And it's a challenge because I think, the economies of scale, being a small populated state, is a challenge. We find that like with our rural areas where we're doing backup care, it's how do we justify full payroll headcount? And we can't, that's why we leverage third parties. So I think that's a challenge, just paying people. And I think, affordable housing, there's so many tentacles in this. I was just talking with somebody out in the hallway after our first session this morning. There's so many moving parts there. We even started to think about strategizing, if you go to the greater Burlington area, how do you aggregate some of the bigger businesses there and form some sort of a care solution? So.
Well, that's exactly what I was getting at, is that you're using third parties right now to deal with markets that, or situations that you can't do with your core businesses. Vermont is the epitome of the third market solution or the third market problem.
Exactly. I've gone and begged and pleaded to our client relations and our business development people. I'm like, you guys, we need to get to Vermont. So
We'll be looking for it.
Absolutely. Well, thank you very much.
Okay, thank you.
Appreciate it.
Okay, next we have Kevin Mead. Kevin, please sit here. Actually, can you just flip the light switch behind you below it there? Now we got
That's a little bit.
the sun has gone in. Welcome, Kevin.
Good afternoon, Madam Chairman. Good afternoon, everybody. Kevin Mead, the president of the PCIA, resident of Newport in the North East Kingdom. A year ago, we were all here and we were telling you that the Vermont as a captive domicile was number 3 in the world. Now we're here to tell you we're number 1 in the world. So,
Great.
and as I say, that's an overnight success that took 42 years of very hard work on the part of everybody involved in the industry. That gives us a level of global notoriety. For family reasons, I'm spending time in Europe, and I'm calling up people involved in the captive industry in Europe and saying, these guys don't know me. I'm saying, hi, I'm Kevin Mead. I'm with the Vermont Captive Insurance Association. Can we get up? And they're like, yes, we'll have a meeting with you. People want to understand what the secret sauce is here in Vermont. And I think you heard from Gail what the secret sauce is. It's that infrastructure. It's those professionals working both in the DFR and within the professions that support the captive industry that are providing that secret sauce. And other states can and do. There are now 41 states, plus the District of Columbia, plus Puerto Rico, and at least one tribe of native tribe that are captive domiciles. But they don't have that infrastructure that we have. They can copy, and they do, the Vermont statutes and regulations, but without that infrastructure behind to provide that support to people who want to establish captives here, they will not have the success that we've had.
We've also been told that the legislature acts quickly when asked to make adjustments. I know we have a captive bill every year.
And that's
I've never known it to
absolutely-
fail. It goes through here, it goes right through.
And it's absolutely a part of it because Gail and her over 650 fellow captive owners are looking for a regulatory environment that is supportive of their business goals and objectives. Gail talks about how that's a dynamic business, it's changing. So the regulations have to change on a regular basis. And Vermont is at the leading edge of having effective regulation. And obviously you guys are a strong part of that, and we thank you for that. In terms of our impact, we held our conference in Burlington last year, had over 1,100 people attend that conference. We are bigger as an event than the next 2 major captive conferences held in the US combined. We have de facto become the global conference. Even though we are Vermont Captive Insurance Association, it is one of the major conferences in the world. And to give you another, I'm big on anecdotes, as you can tell. Brittany's great on facts and figures. With me, you get anecdotes. I was sitting at our conference with a lady who, standard conference room. Where are you from? Yuma, Arizona. And I said, okay, that's going to be one of the more difficult flights to make. And it is. And I said, so do you have a Vermont captive? And she said, oh no, we're an Arizona agricultural machinery manufacturer with an Arizona captive. To which my natural response was, and yet here you are. And the answer was, well, when I established my Arizona captive, they said, make sure you go to Vermont because that's where you get the best education. So we're producing an event that is globally attractive for those 1,100 people. We also take road shows, literally out on the road. Last year, Madam Chairman, you asked me, what's the next captive?
Yes,
Do you remember that?
yes, I do.
And you probably asked all my predecessors the same question. And my answer was, it might be captives, but it might be captives globally. And after that, when we were here last year, we took a road show to Mexico. And I was joined by Brittany and Sandy and some of Sandy's colleagues. And we went to Mexico, and there's a significant interest in captive insurance as a business in Mexico and in Latin America. And Brittany and I are following up on that even as we speak. So just a couple of quick things about threats. I talked to you about those 41 other states that have a captive regime. Other countries are spinning up as well. Just last year, France and Italy established captive domains. The United Kingdom is looking at establish one as well. The next big challenge we face is we'd love to bring more than 1,100 people here. Getting 1,100 people into Burlington is a tough proposition.
Yes.
6 hotels, busing people around, etc., etc. getting 1,100 people landed into Burlington Airport in a 2-day time frame means, don't have your family visit you here from out of state because I'm taking every airline seat available. Luckily, folks like Gail can drive in, but other than that, we've got some logistical issues here.
Yeah.
If we want to expand that, and we think we can expand it because we've got that reputation. And you've heard from Gail already about the professionals. In the state, we need that pipeline of professionals. We need, and you'll hear from Brittany about this as well, we need that strong professional group of people that can support the industry here
Wonder
in
if you
Vermont.
could get a ski resort off season.
They are reasonably priced, that's
I'm sure
for sure. But yeah,
but it's harder to get to because none of them are a cab's ride from the airport.
precisely, yeah.
Yeah, we have an issue with transportation in and out.
In fact, your colleagues in House were asking whether we would like to be a part of some effective some lobbying to expand air transport to South Burlington.
Senator Clark.
We have good passenger rail service.
We do. And the fact we have people that can drive in and we've got passenger rail service into Connecticut and New York and then beyond that is helpful as well. So
Now here we're getting new Amtrak cars. And someday we may be able to go to Montreal.
even better. Yeah,
Yeah.
Okay, I'm gonna have to move things along
absolutely.
because we booked a half hour and we've got more people than usual this year. That's great. And we will go over. I've got Sandy. But Sandy, I'm gonna be here later, right?
Yeah, I think Brittany
We
should
got
go,
Brittany next.
and
Okay,
then if there's time for me.
thank you.
All right.
So we will have you in. Definitely. If there is a captive bill in the house. And it is coming this way.
Hello, thanks for having me. My name is Brittany Evans, and I'm the Captive Insurance Economic Development Director with the Department of Economic Development.
Okay.
Yes, and that is within the Agency of Commerce and Community Development, as you're probably aware. I think I spoke with you all 2 years ago virtually, so some of you may remember me. But it was kind of.
There's a lot of
as a-
virtual faces.
Yeah.
In person makes it much.
Yes, much better, yeah. Well, I'll try to keep it short as well. I think a lot of what Kevin was speaking about and Gail, there's some overlap with what I'll be talking about, but I'll mostly focus on the economic impact to the state because you're probably curious about that and what we've done over the last year, and then I'll elaborate on some of the challenges that Kevin was just talking about. So I am a team of one, or in the Economic Development Department, but the Vermont Department of Financial Regulation in the captive division, there's about 30 plus staff members there that are
And
regulators.
we, or the department, spun your job off because of the conflict between trying to encourage and trying to regulate at the same time. We've got that issue in at least one other place in this state. But
Yes,
it's worked out
yeah.
very well because you
Yes.
can recruit and DFR can regulate. and
Yes.
You don't get that conflict.
Yeah, exactly. I can focus on marketing the state and recruiting businesses to license their captive in Vermont without then having to also regulate them. So it's a great model that's been replicated by states already. As you may have heard, many things in Vermont are replicated around the country and the world that we do in this industry. And my predecessor is here actually, Ian Davis. So he was in my role back in the day, and people tend to stay in this industry that were in it before. So once we can get them into the workforce, they tend to stay. Just to give a couple of statistics, again, I don't want to be redundant, but we licensed 38 new captive insurance companies in 2023. And already in 2024, we've licensed 9 new captives with more in the pipeline. So another great year. It's among our top 10 highest in our 42-year history. So we've had a lot of high growth years in recent years. So doing really well. At least 7 of the new captives have international roots, coming from Canada, Chile, Germany, and the United Kingdom.
It's gonna be at least 5, maybe 10 minutes.
So, yeah, so nine of the last, or 7 of those captives of the 38 were from, Canada, Chile, Germany, UK. And we have, captive insurance companies with foreign ownership from 25 different countries. So we are global, yeah, and we're #1 as of this year, so, definitely everything we do in Vermont, the whole world is watching in this industry, and, it's one way that Vermont is on the global, kind of market, and it's one way that we get to really proudly talk about.
Maple Syrup captive insurance.
Yes, exactly, yeah. Yeah, we had our trade mission to Mexico City. We're working on that again, trying to maybe go back to Mexico this year. We're finding in Mexico that the manufacturing companies have US risk and they import to the US in large numbers. So it's a great place and it's our neighbor to focus some of our international efforts. As you know, over half of the Dow Jones 30s and Fortune 100 companies have captives in Vermont. But it's not just specific to large companies, it's also small and medium-sized companies, and we're the leader in risk retention group captives as well. We won a few different awards this year, as we do most years. We won Domicile of the Year Award by Captive International. We won International Domicile of the Year Award by Captive Review, so we actually accepted that award in Luxembourg again this year. And Deputy Commissioner Sandy Bigglestone spoke on 2 panels at the conference this year. So we're really just becoming more and more well-known across the pond, so to speak. And Sandy also was named the 3rd most influential captive insurance professional in the world out of 15. So that keeps kind of going up. But it really speaks to the influence we have here in Vermont. I can count on my hand the number of regulators that are even on that
I can't
list.
think of any other department or section of state government that talks about going to Mexico and Luxembourg, and usually it's DC and
Yes,
maybe
Right.
California is a long way away. So,
yeah,
yeah, this is different for us. This is an
Yes.
international market,
yes,
and that it just proves that sometimes small does work well.
yeah, definitely. And focusing the efforts really intentionally over time has really paid off for us. So just to keep moving along, so the captive insurance program has generated about $635 million to date since 1981. And that is just in tax revenue, so not including fees. And this past year, it's estimated that we had about $31.7 million in revenue, tax revenue. And then we had about 2 million in addition to that in license and exam fees. And we have about 400 direct high-paying jobs for Vermonters in this industry, paying on average $92,000 a year. That is a little bit outdated, that data, and with our growth, we believe it's more than that. And likely they're paid a little bit higher on average as well. So these are really great jobs for Vermonters here, and part of the challenge is that they don't really know that this is an industry that they can work in. So I'll touch on that more briefly in a moment, but the direct contribution to the state's GDP has been about $100 million yearly through the service providers here in the state, through the conference, and also visits from captive insurance companies that have their meetings here. We're called the gold standard because of that infrastructure, because of the expert regulatory team, and also because of our lawmakers that pass an annual bill. I know it's a little bit tedious maybe to be doing this every
I get
year.
to do it every year.
But you should know that the rest of the world is watching and mimicking what you do here, honestly. And so we just really thank you for making this a priority every year. And I would echo what Kevin was talking about with the hotel, airport, conference center challenge. He spoke in an earlier committee about connecting with UVM to possibly use their dorm rooms. And, as much as that, doesn't seem like a big deal maybe to the average person, we're talking about an industry with competition in the
Yeah.
best cities around the world.
Yeah.
And so,
Burlington is not Luxembourg.
yes, we have our nature, we have our outdoor activities, but if we don't have even the infrastructure to support that kind of conference, it's gonna continue to be a problem. So we're doing brainstorming and hoping that you keep that in the back of your mind in your work too.
Burlington needs a conference center.
Yes. I think
And
that would help a lot,
Yeah.
for sure. A place that's exciting that other organizations could utilize too, not just us, but I've heard multiple organizations have had this challenge as well. As far as the workforce challenge, we started this initiative called the Vermont Captive Insurance Emerging Leaders Initiative with the association. So the association has funded this initiative, and we started it because we realized that companies and service providers were not finding the people in Vermont to fill the growing number of positions in this industry. And so we knew that it wasn't just one person couldn't solve the problem, so we brought together a team of about 30 within the industry. Ian is part of that group and others. So it represents all the different roles in the captive industry, and we have focused on raising awareness about the captive career path within the state and with colleges. And we've had multiple panels, we've had two educational events, networking opportunities. There's a new sponsorship program with the conference, so getting students to attend the conference and other opportunities for free is a big priority. So we're taking steps, and we also have a new web page and with information. So we're making progress, but it takes some time. And I don't think Kevin quite got to this, but there's a road show coming up on March 27th. That is we call it a road show because we go across the country and world talking to people, but it's actually going to be in Burlington this year. And so that's a great opportunity if any of you are interested in taking a deeper dive into learning about the industry and hearing from captive owners. There's going to be a Vermont company that's going to be speaking, as well as a more national company. So we encourage you to attend that or the conference as well.
So we've been very successful, but we're running in to the limitations of our size. We do not have a place. We want you to require you to have your annual conference here, and yet we haven't got the space to put you up, so we may need to work with you on that.
Yeah, I would love to speak with anyone about that and try to do some brainstorming. I think with this challenge, it's obviously going to take some time to build out maybe a conference center or something, but
Oh, yeah.
it's something that the problem is only going to get worse, in my opinion.
Well, we hate to work this hard and find out you have to move to New York to get conference.
Right, or have our conference out of state
Out
or
of state.
something.
Yeah.
Yes, exactly.
Okay.
So,
But you have to grow.
yes, we're going to keep growing. I think it's just
Good.
a matter of, we're
We love
now
that.
number one. And people see that, so they want to come to Vermont, they want to learn here, and they want to travel here, but the cost and the barriers make it
It is
challenging.
not an easy place. There's no direct flights here,
Yes,
so, yeah.
yeah, and same for us, we're traveling all around the world, and it can be tough.
Yeah.
For us to get out there, so, but yes, I'm available for any questions.
Okay.
Thank you.
Senator McCormick, you have a question?
Thanks. What does a conference center that you would like have that our present facilities don't have? Because I've been to conferences,
Yeah,
because I come from a small mill town, so I'm pretty impressed.
yeah.
But pretty long.
Well, I think it's a good question. Honestly, I haven't thought in a ton of detail about what it would look like, and maybe the BCIA has thought in more detail, but I think we want a clean, inspiring, innovative feeling to our conference and what we
Being
do.
on the lake is beautiful,
Yes,
but you need rooms for 1,100 people.
yes, the rooms is a big part of it, and the hotels, we notice when we look at the hotels during the week of the conference, they're $700 a night. They go up, and so it is just, I think the rooms is really a big part of the challenge. The transportation's getting better as more Uber drivers come back into the fold after the pandemic, but the DoubleTree is a great space, and I don't want to talk poorly about it. It's just that we're talking about state-of-the-art conference centers around the world that are.
Their rooms are cheaper.
They are, yeah, I mean, occasionally you get a $500, and that would be expensive. On average, I would say it ends up being 200, 300 a night. But 700 a night is not like any other conference we travel to.
Okay, so we need to work on that.
Yeah,
Okay.
but I know you started this by saying we always have good news, and it's generally good
Well,
news.
it
It's
is good
just
news.
the
We have
challenges.
just grown so much. We are starting to outgrowing ourselves. And we need to find a way, and I don't think we're going to build a conference center in the next year or two.
Right.
So maybe we need to figure out how to bus people, maybe from New Hampshire, which is east, that's on the main flight route. And
Yeah, we thought about some different.
and bus things throws up kind of thing. It's a nice ride,
It is. It's very beautiful.
Very pretty.
Which hours
It is
to our
snow.
end.
but you're in July, so you don't need to deal with snow.
Exactly.
How many people can we get, have bus to the State House?
Yeah. Yeah.
Okay, thank
Well,
you.
it's not a problem that we can't solve together, so I'm hopeful. Yeah. Well, thank you for your time.
Okay, well, thank you and thank everybody for all the work that you do. We've been trying for how many years to do the second captive, and we haven't found one yet. You are our success story.
One day.
Yeah, so thank you very much.
And I will be on that week.
Yes, we're doing that. We have now putting state funds in credit unions, so we'll see where that. Yeah, I think that. Thank you. So. Okay. Yeah, we are going on to 180. Which. And I'm waiting for the folks to come in. We have the sparring partners coming, the banks. And the credit unions,
Leaving the best Western.
so,
And never the twain shall meet.
well, let's hope. We just had a very successful morning with Catholic Church, so.
Sure you want to ruin it?
We want to continue on that upbeat. But we've already did one walkthrough with the
Yeah.
bills, and Chris, I've got you on first. I don't know if it works better for you or to have Joe come up and make his case and then, okay, then we'll
I
do
think it's
Joe
better for Chris
first.
to go first, the way it was on the schedule.
I agree.
2 against.
Okay, you're outvoted. You should have got your lobbyists.
As long as I can get a rebuttal. Isn't that the way it works,
Yes.
right? Good afternoon, Madam Chair.
Good afternoon. We haven't
Committee
seen
members?
you in a long time.
You haven't seen me in a long time, and believe me, I appreciate it.
No, you do.
Although I also appreciate the full employment that this body gives me every year, so thank you.
That's right. If you didn't do anything bad, you wouldn't have a
I
job.
wouldn't have a job. So for the record, Chris Delia, President of Vermont Bankers Association, again, thank you very much for allowing me to come in and visit with you. I'm here to talk about S-180, and probably none of my testimony will be surprising to you. I think it's been quite some time since we've had a credit union bill in the State House. most of what we see over the last few years are bills that impact our industries jointly. So we work cooperatively on a lot of those issues
I can't
together.
remember. It seems somewhere about 10 years ago. I
Yeah,
remember
we did
there
the
being-
rewrite of the statutes.
Yeah.
Yeah. So I want to be very clear with you folks that I'm not here to tell you that credit unions are evil and there's no place in the market for them and we want to put them out of business. That's not the case at all. There's definitely room in the marketplace for credit unions and many other players that are out there. But I think it's important for you folks to have a little bit of background and to know that not all credit unions are the same in the marketplace from our perspective. Contained in the Federal Credit Union Act is language that places emphasis on serving people of modest means, what some might call the unbankable, which still exists in the
History
marketplace
and
today.
origin. of credit unions.
Correct. Built around a common bond, but serving people of modest means. And we know in Vermont, there are a number of credit unions that continue to do just that. I think Opportunities Credit Union would be a very good example of one that adheres to that core mission. In fact, a number of our banks have invested in Opportunities Credit Union to help them with those efforts. But we do feel, we do support those types of activities, but we also know that as times change, the industry, some players in the industry have evolved over time. And they've moved away from that core mission of modest means to serve everybody. The common bond has grown beyond just state employees or in Springfield, what might have been the pool industry down there. And that's fine. There's nothing wrong with growth and the change in activities in the market, but the regulatory policies have not kept pace with that. And that's not necessarily an issue for you folks. We've had many discussions down in Washington, but so again, we know where changes need to occur if they do. But I think a good parallel to how things evolve and are looked at in the market, if we were back in the late 40s, early 50s, your Northfield Savings Bank, which is a mutual, it's owned by its depositors, evolved in the marketplace like many mutual savings banks. And over time, Congress realized that given this evolution, they should no longer be tax exempt. And therefore they pay taxes like other financial institutions. Congress has chosen for whatever reason not to make that decision with credit unions, although we would argue, look at some of the largest ones in Vermont and on paper offering the same products and services that our folks do. So we recognize that change occurs, but again, we feel policies haven't kept up to it. So important to this discussion for you folks is the understanding of a couple of things. One is tax policy. So in Vermont, banks pay a franchise tax. That is a tax on deposits that are put into that institution. If we have a bank that is in the Vermont market that does not have deposits, they get captured under unitary combined reporting. They also were subject to the changes that you folks made in the corporate income tax, I think a year ago or maybe 2 years ago.
Me too.
Right. So credit unions in the market in Vermont are not subject to the franchise tax. They do pay property tax, they do pay employer tax, but when it comes to the deposits, they don't pay that tax. So when you have a discussion like this, and you look at tax dollars, where state tax dollars would be going, for every state deposit that you put in a credit union, you are not going to get tax revenue from that. So every tax dollar that gets put into that institution, you will not collect a franchise tax on. Now, we all read the news, we all know the struggles that you folks are going to have to address over the next few months when we are dealing with very big priorities that the legislature wants to continue with or move forward with. When we look at going back to a more normal revenue stream, the pandemic monies are either blown through or they've been allocated. In our view, it sounds like every tax dollar counts. And moving away from these types of accounts in our financial institutions is going to mean less revenue to you folks. We also, again, talking with our folks, they just feel it's fundamentally unfair to have taxpayer dollars being accessed by entities that are not taxpayers and contributing to the coffers. I think it's also important for you to know another issue, and this ties in with the treasurer's office and working with Beth Pierce years ago. So when Beth first started out as treasurer, she came to us and wanted to create an investment program where she could place state dollars with local institutions. And part of the criteria that she used in that program was the Community Reinvestment Act that all of our banks are subject to. In fact, we're now reviewing the 1,500 pages of new CRA Act to determine how we need to move forward and comply. And we're examined on a regular basis, and we get ratings, outstanding, satisfactory, et cetera. And under the program that Treasurer Pierce created, it was always a target of an outstanding rating. And she knew the funds that were being placed in that institution were supporting what CRA requires us to look at, which is serving low-income communities. And again, we're examined on it. So to my knowledge, that program, that rating still exists today, or that criteria still exists today. Credit unions are not subject to a Community Reinvestment Act. And my guess is because, again, you go back to that enabling legislation, serving communities of modest means, low-income individuals. But if you evolve over time and move away from that core mission, there's no measurement of that in the credit union community. So if you were to place state tax dollars there, how are you going to measure its benefit? What are you going to use, or what would the treasurer use as criteria for judging what they would get for a return beyond just the interest that would be paid on that investment to the state? So we look at those two issues and we feel that this is not a good bill. We all know, both Joe's members and my members know all too well, the cost of capital in the marketplace. Accessing that capital has changed dramatically over the last couple of years, thanks to the Federal Reserve. If you have complaints, I'll give you the names and contact information of the Fed governors. But that's the reality of the world that we're in today. Cost of capital is very high. We're all scraping to find deposits, but cost of deposits are high as well. It's all part of the mix. Balance sheets are stressed because we've gone from an environment of very low interest rates and carrying loans for an extended period of time. Those loans are still on the books, but obviously, again, interest rates have changed dramatically. So, we get probably some of the rationale for asking this, but we would ask you not to move forward with this bill. It's a continuation of what we would call an unlevel playing field out there. This is something in your control here, so we would ask you not to do it. If you have any questions, I can certainly answer them. I have members who I'm sure would happy to email you and chat with you.
Your members have been on the email.
And I would appreciate either in the chair or follow up in writing, based on the comments that I hear from the next witness.
Okay.
To offer any additional thoughts.
So this community investment started with Treasurer Pierce. And this was part of the 10% for Vermont. It was.
She called it the Bank of Vermont program at the
Okay.
time, so 10% was carved out and was different. This was the Bank of Vermont, and it
Yes,
was a
it
way
was-
for her to,
there was a whole push for community, for a state bank.
yes,
And Vita did the business loans.
Yes.
And she did a study on capital, and there was no difficulty then with access to capital.
right,
And she wanted to invest, and there was a lot of discussion in this committee.
Yep.
And so the deposits were put in.
Yeah.
To help the banks, and I guess the credit unions that had a community reinvestment.
which was the under the statute, Community Development Credit Union. Yes.
So,
But I don't think it was a statutory change at that time. It was just the underlying statute was there.
Yeah.
She just had the desire to move forward with a new program to put those
Okay.
investments in the Vermont market.
So now your testimony is that banks have to do a community reinvestment. That's the law. They are,
Correct.
so they do that. So when we put money in, we're getting a community reinvestment, plus we're taxing you on that money.
Correct.
Okay, so that's where the banks are. All right,
Correct.
Senator Gray, you have a question?
Please, please. Yeah, good to see you again. Can you remind me of forgetting some of the math here, like what the bank tax proceeds are? And
It's-
where those funds go?
Yep, so they go to the general fund. I don't think you've made any changes to that historically. It's like it's 0.6092 or 96 that's applied to the deposits. The revenue collected has fluctuated over the last few years because you had so much pandemic money coming in. But I think on average, you were in the $12 million range that was being collected and pushed to the general.
Chunk change then.
Right,
And do you have any idea of what the deposits held by the credit unions are?
I would defer to the next witness to talk about that.
Okay. Any other questions for Chris? Thank you.
Thank you.
And do you want to frame the argument or is Joe? Okay, Joe, come on.
Thank you, Madam Chair, committee members. For the record, my name is Joe Bergeron. I'm President of the Association of Vermont Credit Unions, the Trade Association for Credit Unions of Vermont. And no, it's been a long time since we've had credit union or bank specific
Yeah.
legislation in
You
this
haven't been
state
here in
house.
a long time.
Correct. Most of the legislation that we both of us end up acting on during the course of the session is consumer protection related type activities and whatnot. So I'm really glad to be able to be talking to you about something that is specific to credit unions and I guess specific to the community, thanks in an indirect way too. So again, thank you for the opportunity to talk to you about S-180. As you know, it's a very short piece of legislation that just deletes 2 words from statutory language. And I've got some information that I want to share with you to kind of frame the discussion, particularly in light of what Chris just shared with you about, his impression of credit unions and whatnot. But there's a couple points that he was touching on, conversing with you on that I wanted to pick up on before I forget those. That Community Reinvestment Act discussion, that's a federal provision, federal requirement that came into place by Congress a long time ago because of banks, savings and loans specifically, that were taking money from the deposits from the communities in which they were operating, their footprint in Vermont, let's say, I'm not suggesting Vermont institutions did that, but let's say it's Vermont. And investing those funds in projects far flung from here, in a strip mall in Florida or whatever else. So that's the reason that requirement on for-profit financial institutions need to be. Credit unions are not subject to CRA because credit unions cannot do that activity. Credit unions can only invest their funds, although we offer checking accounts and mortgages and new and used car loans and so on and so forth, much like you see at any community bank in Vermont. The structure is very different and their authorities are very different in terms of what they can do with the deposit that they receive. And so they're limited to making loans for the most part to people that are members of the credit union who are people in the communities that they serve. So they can't invest in a strip mall in Florida unless the credit union is located next to that strip mall in Florida and that strip mall is a member. So I just want to get that out of my head while I'm thinking of. The other thing that jumped out at me is the reference to the bank franchise tax. Neither banks nor credit unions in Vermont are subject to a corporate tax of any sort. Banks in Vermont are subject to the bank franchise tax. And that's the calculation of which is, as Chris referenced, like the 6 zeros followed by 9 and 6 times the amount of deposits. In this case, we're only talking about the deposits that may be made by the treasurer's office in a financial institution. So it's a small calculation, or should be a small calculation. I can't tell you the amount of dollars that the treasurer's office has placed in Vermont community banks. Because in those numbers are also mixed whatever dollars they may have on deposit from municipalities throughout the state. So they're co-mingled as far as the information reports that I can see. So we can distinguish between those two. So with that note, let me, and excuse me for reading, I don't typically like to do that, but I don't want to ramble on, so I want to be specific here in what I share with you. By way of background, there's 16 cooperative credit unions headquartered in Vermont, 11 of which are chartered under Vermont law and 5 under federal law. Together, they have 89 locations in communities around the state of Vermont, serving 430,000 Vermonters. And all told, they have about $6.6 billion in assets altogether. About 6 of them are open to membership by anyone in the state of Vermont. The smallest one is a $622,000. That's really small by financial institution standards. The $622,000 church-based credit union operated by a single person who's a retired postmaster. And they range up to our largest credit union, which is about a $3 billion cooperative. That's the largest financial institution of any type, bank or credit union, headquartered in the state of Vermont. Credit unions are sophisticated cooperative financial institutions providing, as I said, a similar range of products and services to traditional banks, but often with more favorable rates and fees. Credit unions are cooperatives, so there's no group of members or outside owners who need to make profits. After setting aside reserves that are mandated by law for safety and soundness, profits are returned to those 430,000 members of Vermont credit unions. In 2023, those credit unions provided about $61 million in financial benefit to those 430,000 Vermonters. That $61 million is the difference between the rates and fees that credit unions afford the people that do business with them versus the rates and fees that those same people would have access to if they were dealing with another type of financial institution out there. So it's a difference in rates and fees. It's not the whole benefit that they get from the credit union. For example, financing, let's say a $25,000 to help you buy a new car. Maybe you traded in your car and whatever it is, you're having to borrow another $25,000. It's a new car, you're borrowing that $25,000 for say 60 months out of Vermont Credit Union. The differential in rates on that loan would save the borrower a little over $100 per year in interest expense over the life of that loan compared to the loan the borrower would have gotten elsewhere. We track that kind of information, and our National Association does what we do on a state-by-state basis from an entity called DataTrack and some other federal sources that monitor all the rates and fee structures of financial institutions of different types in every state in the country. It's fair to say that using other kinds of institutions, people that use other institutions also benefit because of the competitive pressure that cooperative credit unions in the state, in every state, create. It's widely accepted that credit unions often have more favorable rates and fees than a lot of other financial institutions, not all of them, but many of them. And continuing a prohibition against credit unions as a depository option just doesn't make sense. And that's what our current law does. Everyone that does business with a credit union is an owner and shares in the profits. Credit unions could send a check at the end of the year to those member owners, the people doing business with them, the 430,000, but instead give their profits to members through rates and fees. That creates a benchmark in the marketplace with which other providers have to compete. Remove credit unions from the marketplace and there's less competition. So the need to compete becomes less the rates and fees in the marketplace become less favorable. So it makes sense that at least to some degree, everyone in the state of Vermont benefits from the presence of cooperatively structured credit unions in our state. Now let me talk about S-180 specifically. As worded, it doesn't alter any powers or authority of credit unions, state or federally chartered in any way. Nor does it require state government or anyone else to place any deposits in the credit union. What it does do is enhance the options, expand the options for the placement of deposits by state government in Vermont. 32 VSA subsection 433, which is referenced in the short bill, defines the permitted places in which the state can deposit its funds. Under this current law, the state can use a variety of depositories, including banks and credit unions. Oddly, the statute limits the types of credit unions to small ones. Of the 16 credit unions of Vermont, the only ones in which the state can deposit currently are 2 small community development credit unions, one of which was already referenced, Opportunities. The focus of a community development credit union is on services to less financially advantaged Vermonters. They do a good job at it. Of the 2 community development credit unions in the state, one of them has a statewide field of membership, that's Opportunities. But the institution size makes an unlikely option for the deposit of state funds. There are 14 other locally domiciled credit unions in Vermont who aren't currently an option for the treasurer's office, even though about 66% of Vermonters choose to do business with them. Those 14 credit unions comprise about 99% of all the credit union assets in the state of Vermont. All S-180 does is delete 2 words, community and development, and leaves the words credit union. Doing so broadens the state's competitive options, and I think we'd all agree that competition usually is good for all of us when we're shopping around for that car loan or whatever else. And it would no longer exclude credit unions who would be, if asked, the best among credit unions able to serve the state's needs, if it chose to do that. If the treasurer chose to deposit in a credit union, and remember, it's not required to, it would enjoy the same favorable rates and fees as those 430,000 Vermonters already do. To no surprise, you already heard opposition by my counterpart in banking lobby to the simple 2-word deletion. That opposition is an argument against competition in the marketplace and against providing the state with more choice of depository options. That argument just doesn't justify, in my mind, a prohibition against those 14 credit unions as a depository option in today's landscape. There's 3 things that came to mind when I was trying to forecast what Chris might reference. A couple of them he did reference. And the first one is that credit unions don't pay taxes, so why should they hold public funds of any sort? But in fact, and I think was referenced, and thank you, credit unions do pay taxes. They pay payroll taxes, real estate taxes, personal property tax where they exist, rooms and meals tax. Like I said, neither banks nor credit unions pay corporate taxes in Vermont, but because of their type of charter, banks do remit to the state that bank franchise tax that we both touched on with all the zeros and the 96 on the end. Credit unions aren't subject to the bank franchise tax or any form of federal corporate tax because of their not-for-profit cooperative structure. The second one is reducing deposits in banks harms the state because revenue from the bank franchise tax would be reduced. Nothing in the proposal mandates the use of credit unions as a depository of state funds. If the treasurer's office did consider a credit union as a depository, I have no doubt it would weigh, because my staff does a good job of this, they would weigh any differing interest rates between depositories and account for whatever minimal reduction there might be in bank franchise tax revenue, if any. In fact, I guess I propose to you that instead of state funds moving from a local community bank to a credit union, I think it more likely that enhancing the in-state options for the state treasurer's office would possibly bring more funds into local depositories in state than having them in out-of-state institutions or out-of-state domiciled institutions. Chris also referenced about some credit unions straying too far from their original mission. You know, credit unions have become very popular for whatever reason over the past decade. Prior to that, and I've been doing this job for 40+ years, we would have to explain to people what is a credit union. It's not a labor union, and so on and so forth. And ever since the Great Recession, the 2008 mortgage, credit unions have become extremely popular. There are 137 million members of credit unions across this country, and the 430 that I referenced here. Credit unions holding deposits for government entities is completely consistent with the credit union mission and purpose, because the benefit provided to local taxpayers, communities, and members makes it so. They put everything that they make back into the people and the communities in which they operate. In a modern world where there's been lots of consolidation of financial services, we have a lot fewer community banks and a lot fewer credit unions than we did 10, 20, 30 years ago. And where membership in cooperative credit unions, like I just said, is more widespread than ever, we're long overdue to enhance the state's depository options by no longer excluding over half of the Vermont domiciled institutions. There are more credit unions in Vermont than there are community banks, and our current law excludes, like I said, 14 of those 16 credit unions. Removal of just those two words, as proposed in S80, does that without changing anything about Vermont credit unions. There's no power or authority that changes, and without requiring the state treasurer's office to do anything different than it already does. So that's all of my prepared remarks. I've got some other thoughts I could share with you, but I think it'd probably be better for me just to say questions, comments, reactions, or you can move on to the next issue of the day.
Well, we're trying to get our next witness to come early, but Senator Brock.
Just trying to understand, the issue and the differences. Of course, the difference that I've heard, and correct me if I misinterpret, is that by virtue of your being able to take those state funds into a credit union has a potential advantage in that it does not have to pay a franchise tax based on the interest rates and so on of those funds. Is that effectively the difference? In other words, you do not have to pay the tax. The community banks do in fact have to pay such.
So there's state chartered credit unions in Vermont, and there's federally chartered credit unions in Vermont. All the larger ones are federally chartered credit unions. And so that bank franchise tax, wouldn't apply to them anyway. The state chartered credit unions, are exempt from the bank franchise tax because of their structure, because they're cooperatives.
Sure.
So all the deposit dollars, wherever they come from, whether it's your pocket, my pocket, state government, restaurant down the street, or whatever, go back to the members of those credit unions, individuals, by way of loans, and they get better rates and lower fees and better rates in their savings because of the structure of the credit union.
And the understanding of what I'm hearing, at least from Chris's presentation compared to yours, is that Chris's organizations feel that they are disadvantaged in that they don't have the ability to do anything other than with the tax, other than pay it to the state. That's one. And two, by virtue of the money not being paid to the state in that situation, you have a advantage in your business compared to theirs. In other words, the two businesses are effectively being treated differently by government from a tax perspective.
And there's a reason for that difference.
Yeah.
And it's the benefit that credit unions are, the enhanced benefit that credit unions are able to provide because they're cooperatives and structured as not-for-profit cooperatives.
And that though goes back to the quote shareholders of the credit union, just like profits from the bank go to the shareholders of the banks. But in this case, as far as the state is concerned, the state would be losing money, wouldn't it?
As I said, I'm not envisioning that the state of Vermont is going to invest or place a CD. Less of those dollars into community banks, but might be placing more dollars that currently go to TD Bank or an M&T Bank or whatever in a Vermont credit union. And community banks might benefit from that as well. So, you know, if it did,
I'm sorry, I didn't quite understand that.
the Bank in Vermont program that Chris referenced
Mhm.
is the most obvious program that community banks and credit unions, if credit unions are included in Vermont.
Mhm.
That's the most obvious program that we're talking about here. So if you go on the treasurer's website, you'll see a list of 8 community banks in Vermont who have applied to the treasurer's office for the permission to be on that list. And they have to meet certain criteria. The state of Vermont, if it's going to place any funds with X financial institution, wants to verify that institution's safety and soundness and so on and so forth, rightfully so. So there are 8 out of the 11 or so banks, the community banks in the state of Vermont, that are on that list because they've applied, they have an interest and they've applied to do so. Great. From time to time, the state treasurer's office puts out a request for proposal saying, hey, we're going to make X number of dollars, whatever amount it is. We're going to invest it in some laddered CDs, and we want to do it in this Bank of Vermont program. That's the program that Beth Pierce originated whenever that happened. And just because a financial institution submits an RFP and is on that list, doesn't mean that it's going to be one of the successful candidates. The treasurer's office is going to say, well, we want at least this rate of return, we want these terms, so on and so forth. And based on liquidity of that institution and what its ability to pay interest is, and so on and so forth, it may or may not be in agreement with the state of Vermont's desired terms, and it may or may not pursue that with them. So what I'm saying is that credit unions are excluded from that list. The 2 community development credit unions could apply to be on that list. They haven't. They're not going to be successful. They're too small to be able to be a recipient of those investments whenever the state does that. But there's 14 other credit unions, maybe a handful of which are large enough that they would be attractive, could be attractive to the state treasurer's office. Again, it's up to each institution and how they want to reply to that RFP, or if they want to apply to that RFP. So I'm sorry, I've rambled on a lot. This is what happens when I leave my notes. I've rambled on and I lost your original question.
Well, the original question is you have, sort of the banks have to pay the franchise tax. Credit unions do not have to pay the franchise tax. The argument that I heard from the banks is that is not a fair situation because the 2 institutions are being treated differently for tax purposes.
That assumes one.
If that's the case, and I'm just trying to understand,
One
is
is-
that what's happening from your perspective?
Correct, that Vermont credit unions are not subject to the bank franchise tax, nor should they be because of the corporate structure.
Mhm.
2, that assumes though, what Chris said, and if I'm understanding correctly, that assumes that the state of Vermont is going to say, well, let's not put, I don't know, this $1 million or whatever the dollar amount is in an ABC community bank. Let's put it in an ABC credit union instead. And what I'm posturing is that that's possible, certainly, but more likely in my mind is that they say, we've got more options now, more opportunity. Let's move $1 million, $2 million, whatever it is, from this entity that we have deposits with out of the state into the state, into this local credit union, because we have more options to work with now. So both are viable options. Yes, credit unions are not subject to that tax, but the benefit they generate for consumers who then pay taxes on the additional income that they have in their pocket, does increase the tax base for the state of Vermont.
There's one thing missing in here though.
Sure.
I mean, we're making revenue back franchise tax.
Right.
If we think investing in credit unions, it's our decision if we're gonna, do how much do we want to risk our income. But the other thing that was the purpose when this was set up, I remember the state bank, and I don't think any one of you would have liked the state bank. But the idea was, then this was the reception to get out of Wall Street. So we said, okay, rather than send our money off to Wall Street, we're going to invest it in Vermont
Local
banks
institutions.
and local institutions. But one of the purposes of that was that it would get reinvested in the communities. Banks are required to reinvest in the community.
Mhm.
Credit unions aren't, and it's something about your structure says you can reinvest in your people, giving you lower rates. I'm in a credit union. I'll have to go see if my rates are lower than Northfield Savings Bank. But
Well,
I don't think they're significantly, but you're limited in, you couldn't help build affordable housing. And because you don't pay taxes, you couldn't use the tax credits that banks buy for our affordable housing projects. So you're limited in how much you can reinvest in the community. So we could decide we want to invest in credit unions, but there's a trade-off there. We would lose money. And I think we'd lose some money in community reinvestment.
So unless I'm misunderstanding, credit unions are not limited to what they can invest. They're limited to what's on the balance sheet that they can
Okay.
invest.
No, I thought you
But
said you
they-
were limited to helping members of the credit union or something directly access. You said the shopping center, if the new credit union was next to it, would we invest in the credit union?
So credit unions are limited to investing their deposits in their members. Their members are the people in the footprint of the community, the county, whatever it might be that they serve. And so they're gonna make new car loans, more used car loans, home equity loans, mortgages, and loans for small business as well. And yes, in some instances, if the credit is large enough and has the resources to do so, some local development. But it's all gonna be local in the community that they service. And that, yes, those dollars do all go back into the community.
Okay. So, committee, any other questions? I've got down, I want to get a fiscal note on this. Mr. Delia gave us a $12 million figure, but I'm gonna have our folks look at it and look at how it would scale down depending on where we invested it and how many. And then I want to hear from the treasurer's office, how they view that money and what they think we told them to do with it.
Yeah, so talk about the fairness argument. I can see how some credit unions are getting like banks. There are some banks that are sort of, they're not credit unions, they're banks. But they are community oriented. Where, I don't think I'll mention names, but I have been doing business with the same bank for years. And suddenly, like, everything changed. And what it turned out was that they were no longer carrying the mortgages they sold, now they were selling blocks
Right.
to Wall Street. And my house, like many in Vermont, reflected a lot of sweat equity and could not be included in the group. Identical, there was nothing identical with it. And then I found out that there was like an epidemic of people within my area that doing business with this bank suddenly being cut out of the action. And I will mention the name because I thought they're good guys. Northfield comes along and says, well, yeah, we'll let you. We'll let you. It's not like it was a gift. I was good. I always made my bills on time. And then I played so, but it was that they were not. Now, what about them? They are. Should they be getting a break on the taxes because they're community oriented?
That would be an issue for you and your fellow lawmakers to contemplate, and not me, and I can't opine on that. And, you know, there are lots of different bank structures out there. But credit union, as terms of structure, credit union is a credit union, is a credit union. They all. Hey, I think, you know, your story about banks, and communities that you've dealt with, I think, you know, community banks in Vermont do a very good job. Overall, from time to time, just like in any institution or any business, if there's a change in management, or a change in whatever the leadership is, they have their philosophy, whatever. But I've done a lot of banks in Vermont over my tenure that have been very, I guess I'll call it, credit union alike in their philosophies, but their structure is still different.
Yeah.
But, you know, as far as how they, you know, present themselves to communities, so on and so forth, I love, done a great job.
Senator Ron Hinsdale's got a question and then Senator Bernie.
Thanks, Madam Chair. I'm inclined to support this just from the perspective of growing up in a co-op family. We're big on co-ops. That said, I do have one concern. Some people have heard, I just had a pretty negative experience with Opportunities Credit Union when I myself was looking for a loan after grad school. And it has set me on a path to really trying to better understand if all of our financial institutions are fulfilling either their mission or their stated goal to increase capital access for more women, people of color, and other folks who are undercapitalized. So I'd like to see the data from both entities, from the Bankers Association and from the Credit Union Association, about your members and the percentage of their business and home loans that are going to first generation home buyers or BIPOC owned businesses, et cetera. And that will help me determine where I stand on this.
So
Chris, can you get that data? It sounds like,
I'll try.
sounds pretty broad.
I'll try. I'm not sure if it's available, but I'll try.
Okay,
I do have that data.
Okay.
Both nationally and I'm pretty sure for the state too.
okay, so we'll get that in. Is
I
that-
would suggest that Chris try. He and I have talked about this.
You'll
And
try.
I will certainly try.
great.
Senator Gray.
You heard my question that Mr. Daly suggests I pass along, share with you, which was if you were subject to the same fee that banks are
The bank
subject to.
franchise tax.
Yeah, do you know what the proceeds would be?
Oh, I'd have to do some number crunching and I wouldn't venture a guess off the top of my head. But I can.
Okay,
try to.
yeah, I don't, unless I, or if you know all deposits, you know, run them,
You know,
run the math.
another one of the reasons why credit unions have a different tax treatment than for-profits and other forms of financial institutions is that they are very limited in how they can build capital. We were talking about discussion on that before I took this chair. And that, you know, credit unions only build capital one way, and that's through the business that they do. You can't have someone come in and make an investment in a credit union by buying, you know, shares, which you referenced, and so on and so forth. And it's only from whatever dollars that they're able to generate from that car loan that they, that mortgage to me. And after they pay operating expenses and after they set aside what state and federal regulators require for safety and soundness, set asides and so on and so forth. And after they write off bad loans that some people invariably do not repay, because that happens when you're in that business, then what's left over can go to their capital position and to their depositors to get people to put money into the institution to begin with. And that's the only way that credit unions can build capital. So, you know, that's one of the basic reasons for the difference in tax treatment between different types of institutions.
Oh, thanks for the reminder. I think I just would still like to know the number because people say, well, if we treat them differently, what are the implications?
I will tell you that if credit unions in Vermont, this is one state, right? So credit unions in Vermont, state charter credit unions were subjected to some kind of tax on their earnings on deposits like that. And by the way, the tax that the Vermont legislature imposed, bank franchise tax, on deposits of banks, whenever it occurred, way back when, I believe is because, like we all exercise when we're paying federal taxes, you know, you have deductions off your revenue and so on and so forth. And that varies so much from one financial institution to another. And everybody's going to exercise, you know, tax minimization measures, so on and so forth. So a bank franchise tax was developed on deposits of institutions. Because deposits are pretty steady. They're not going to, you know, fluctuate. You can't influence it too much unless you're driving deposits away or tracking deposits. But if credit unions in Vermont were taxed, and we've seen some studies on this before, credit unions nationwide were taxed, you would see half of the credit unions in the country probably disappear right away. Because they're not structured as corporate entities, being able to provide the kinds of benefits to their member owners that they do and incur corporate tax on top of that in addition to it. And then the other half would be motivated differently, the half that remain. Which would probably be large ones. And they then would be motivated to, if it was corporate tax, they'd be motivated to exercise, tax minimization methods as much as possible. If it's a bank franchise tax, then I would venture to guess that somebody's going to be thinking about, how can we change things somehow so that amount is minimized. But it would be highly detrimental to credit unions as an industry because of their current structure being a cooperative and that form of corporate taxation for bank franchise tax just doesn't fit in that world. But I will get that.
Well, thanks, and thanks for the reminder of why it might be a bad idea.
So. We're running up against time, and Sandy. I know what your schedule is like, can I give the committee a 10-minute break? Oh, absolutely, okay, we were running ahead and I would ask to have you come over a few minutes early. And we run right up to time, but I think they pay better attention if we got a 10-minute. Yeah.
Thank you for the
So,
opportunity
thank
to chat with you.
This is just our first run on this one,
Understood.
so we will see where it goes, and we will have the treasurer's office over and
As you should.
see what they think, and we'll get a fiscal number. Okay, Sandy Gray,
You're the sponsor.
yes.
Can you share with me what you were observing?
I was asked in the cafeteria when the last day, when we were having a briefing, I said yes to get it in for discussion. I have no pride in ownership. Okay, this is a free discussion and we'll see where the committee goes, but, it was just something, it seemed like something worth talking about.
Yeah, for the 5.
So we will, yes, we will talk about it. Okay,
You take off.
committee, yeah.